We've reserved the first couple rows for our distinguished speakers and the various central bank governors and presidents and vice presidents who we're honored to have with us today. There should be room for everyone. My name is Adam Posen, and I'm president of the Peterson Institute for International Economics. And it is always a pleasure to welcome friends and colleagues to this, our Bergston Conference Center here at the Peterson Institute. But it is, of course, a special pleasure today for Rethinking Macroeconomic Policy 4. I am deeply indebted to Olivier Blanchard, of course, now a senior fellow here at the Institute, and to Larry Summers, member of the executive committee of our board of directors, for putting the leadership together to assemble this conference, and frankly, as importantly, or more importantly, to put together the paper that they're going to start with on the need to go back to the future on stabilization policy and other aspects of rethinking macro. If I could just say two words before we turn right into the meat of the session. The first point is just institutional. We at the Peterson Institute, both before but especially after Olivier joined us, have been working very much in the field of applied macroeconomic policy, trying to meet academic standards, but not trying to get caught up in academic diversions. And this conference is obviously a culmination in some ways of that effort, and we are grateful not only to, obviously, Olivier in particular, but so many distinguished friends who've joined us in this spirit. We also must acknowledge, gladly, the IMF, in particular the research department of the IMF and the counselor, Maury Obstfeld, who graciously turned over the Rethinking Macroeconomic Policy brand name to Olivier and I here at the Institute. The reason it's number 4 is because, as many of you are aware and many of you participated, there were 3 previous Rethinking Macroeconomic Policy conferences at the IMF. The IMF yesterday had a very important conference on rethinking globalization, although under a different title. Larry and others here participated in that. But we appreciate the IMF, in a sense, yielding this space to a new entrant carried on by Olivier. But that leads to the 2 minutes of substantive remarks I'll allow myself before you get to hear the people you came to hear. I think it is important to recognize that the other reason we're having a Rethinking Macroeconomic Policy Conference 4 is because we're not yet saved. That as good as the previous 3 conferences are and have been, and the volumes are available from MIT Press, as will our volume this year, they have not yet resolved and to my opinion, fully reckoned with the challenge presented by the failures of macroeconomics and macroeconomic policy over the last few years. And importantly, I think it is always cheap for someone like me, who is not a fully qualified academic, to say this, but I think importantly, we do need to think about the disconnect between much of academic macroeconomics over the last 20 years and the policy outcomes that we should have wanted and expected. And it is always going to be a tension. These two move together, especially when distinguished people like our speakers and many of you here move in and out of academia and government. But there's a dirty secret that I think many of the people in this room knew, which was even before the crisis, if you were doing macroeconomic policy, you were relying on Dornbush and Fisher or Blanchard or your intermediate macro textbook to do most of it, and not the DSGE models and not the forward-looking efforts. And frankly, those were the parts of the policy analysis that held up best through the crisis. Not perfect, but it really was the intermediate macroeconomics and not the fancy stuff of the last 20 years that worked. And I would go further and just say that I think the academic profession, as well as those of us who've been in and out of government, of central banks, have to recognize that the DSGE approach, the emphasis on time and consistency and the inflation bias, the assumption that the long term was all that mattered for both fiscal and monetary policy, the assumption that you could not beat financial markets and financial innovation was always good, that all of these assumptions were not science, They were ex-ante hypotheses that got reinforced by bad incentives in both the academic profession and the surrounding world. And we should not be afraid to step away from these. And so in that regard, to make a much more constructive, detailed statement of how to step away from these, I turn to Olivier Blanchard.
Thank you, Adam. Thank you to all of you for coming. I hope it is indeed an interesting day and a half. As Adam said, this is the fourth conference with that title. And I think for historians of economic thought, looking at the three existing volumes and hopefully the fourth one when it's out, will be fascinating. The first one was in 2010. And if you read it, it's very much the feeling of being in the fog of war. Things are happening and we don't quite know which way it's going to be. Then the next two, probably largely under my influence, were more in the mode of, well, we now know what to do, let's do it right. I suggested, I think, at some point to Larry, the title In the Trenches, which was the idea that we were there just digging carefully, and he suggested that was a bit early. And in the third one, so the last one before this one, there was already more doubts about what we had learned and how much we had actually incorporated it into policy. And then this one, I have a sense, or at least that's going to be the theme of the paper with Larry, that there are some fundamental questions which have not been answered, both in terms of macroeconomics, but more relevant for this crowd, for us, in terms of macroeconomic policy. So this is going to be the theme of these remarks. Okay. So let me give you a rundown of what I intend to say for probably 20, 25 minutes, and then open the floor. I think it's very useful to go back to the two big economic crises of the past, the Great Depression and the stagflation of the 1970s. And both of them led to a dramatic change in the way we thought about the macroeconomy. And the first one introduced the notion of macroeconomics and in terms of macroeconomic policy. And then the question is it going to be the same this time? Or are we seeing some smaller variation of things that we have seen in the past, and there is no need for a dramatic reconstruction? And we're going to say, no, there is a need for change. The way the paper is organized is by drawing what we see as the three main lessons of the crisis, or at least the last 10 years. And then, having done this, show how, in our mind, this maps into how we should think about monetary policy, fiscal policy, financial policies. This is kind of a conceptual frame that we have adopted to present our ideas. So let me start with this slide, which, I mean, is going to talk about things that we all know very well, but I think it's important to actually think about it. So when the Great Depression came, again, like this one, policy was actually ahead of thinking. They did things. It took a while, but policymakers made dramatic actions. And then there was a lot of change in the way people thought about the way the economy worked. They had been very much in the mode of regular fluctuations, and they realized this was probably not the right way of thinking about it. It became clear that the economy could implode, and that you had to do something about it. The notion of aggregate demand became very central, and again, that was new at the time. And given that the economy was not self-stabilizing, there was a need for very aggressive policies. And at the time, there was probably more of a focus on fiscal than on monetary policy, but the notion that fiscal policy was essential as a stabilization device. And lo and behold, this was more or less the approach, a policy approach for quite a while, and it worked very well. It worked very well after the war. until basically the next crisis. So big event, big change. Then came the stagflation of the 1970s, which is not an event of the same magnitude, but had very major implications as well. And the notion was that given that we were seeing both stagnation and inflation, the Keynesian way of thinking about things, which was of a trade-off, was wrong, and there was a need for rethinking. In retrospect, I think that that was not a fundamental criticism, but it was used to basically develop a new approach to theory by people like Lucas and Sargent, who said, no, you really have to start from scratch. And what developed was a much more mundane view of fluctuations, which is that, I mean, the word business cycles, which had more or less disappeared, reappeared as the notion that, yeah, there are ups and downs and you have to handle them, but basically the economy is largely stable, and what you need is very simple rules, clear rules, to make sure that people understand what policy is about, and everything will be fine. With that, there was a shift towards away from fiscal, towards monetary policy, and just before the great financial crisis, there were these what I would call Talmudic discussions about the form of the interest rate rule, whether the coefficient should be 1.5 or 1.2, and what variable exactly should be on the right-hand side. And that was really the major discussion. And again, that approach, for good or bad reasons, worked fairly well from the mid-80s to the crisis. This is a period which is now called the Great Moderation. There was a decrease in variations in output, a decrease in variations in inflation, and many people declared the war won. And then we got the great financial crisis. And so the question is, well, now that we've seen it, now that we've gone through it, what is it that we should conclude? So let me turn to the first half of the paper, which is the three lessons we see that we draw from this crisis. So the first one is the absolutely obvious one, which is the centrality of the financial system. And this is not exactly a strong statement at this point. I think we realized, sorry, yes, I'm looking at my notes and not at the slides, which is an issue. The problem with this, Adam, is that it's too small for those of us who have bad eyes. And so I have to actually look at this. Take a bigger one. Yes, put a bigger one. Okay, but please tell me if I keep talking about slides which are not yet on the screen. So the first one is the obvious one, the centrality of the financial system to a degree that clearly we had missed before. The second one may be, from a conceptual point of view, the most important one, which is the nature of fluctuations. I think this notion of mild fluctuations around an exogenous trend path, must be challenged fairly strongly. And that has major implications. I think the notion that the economy is self-stabilizing is clearly a major question. Then the third one is not really a lesson from the crisis, but it is a lesson about the environment, and that goes to something that Larry has pushed very strongly, but I think rightly, which is what he has called secular stagnation, which is that for the foreseeable future, we're going to be operating in a very different environment from the previous one, an environment of very low rates, and very low rates have major implications for the behavior of the financial system and for the behavior of the economy. So it interacts with the first two. Now, are there other lessons to draw? In an earlier draft, we actually had more lessons, but we reduced it to 3. But I have to mention the other one, which again is not directly related to the crisis, but has come to the fore, which is the salience of inequality. And I think by using salience, I mean both that inequality has increased, but also that it has become more salient. So I think that in terms of political constraints, it is playing a more important role, and that's something that we have to think about. But I'm not going to talk about it in this presentation. So let me go through the 3 main lessons one by one, not forgetting to actually move the slides. Sorry about my voice as well. So the question is, why did we ignore the financial system so much in mainstream macro? And clearly, we have to plead guilty. I mean, when you reread Hyman Minsky, you realize how right he was, at least on these issues, not on all issues, but on these issues. And looking around, going outside of the Anglo-Saxon world, we should have known. I mean, basically, Japan happened, and that was the lost decade. There's now 2 lost decades, more or less. But we dismissed it as, well, they had a shock and they didn't know how to handle it. It was a policy mistake, nothing much deeper than that. And then similar crises were happening in emerging markets in Latin America during that period. But again, that looked like the problem of, poorer countries. It was not going to happen to us. So Anglo-Saxon mainstream macro ignored it. It didn't ignore the financial system. I mean, Ben had important papers on the channels through which the financial system affected the effects of shocks, but the notion of a financial crisis was basically, I think, not present. It was present at some margins, and there was work in corporate finance on liquidity, which we didn't think was very relevant, turned out to be. There was work on leverage, which also turned out to be very important, but we had not really integrated it in our framework. So what has happened since? Actually, I'm extremely impressed by the amount of work which has taken place in academia on the financial system. I mean, if you actually look at the NBR working papers, it's very impressive how much we have learned. So we know much more, but it's the usual line. We know much more, but we still know much less than what we really need to know in order to control the beast next time that there is a problem. And here you could think of a number of issues on which I think we still don't have a good control. And here in the paper with Larry, we took up 2. The first one is, during the crash, the relative roles of solvency and liquidity. Clearly, you need some worry about solvency to get a liquidity crisis, but you need very little to get it going. And what is the relation between the two, and what was the state of the various financial institutions in 2008? Was it liquidity or was it solvency? I think is not fully solved. The fact that TARP came out as a profit suggests that maybe it was liquidity, but maybe it was gambling for resurrection, and we just got lucky that time. But that's a very big issue when you think about how you're going to handle a crisis. If it's liquidity, you do one thing. If it's solvency, you do another one. If it's a mix, then you do both. But it is really not something that we have, I think, a good grasp on. The other is, after the crash, you basically have low capital in various places. I mean, you have high leverage in various places. You have it on the side of the creditors, of the financial intermediaries, which have insufficient capital, and then you have it on the side of the debtors, households, who are over-leveraged. And the question is, which one should you go after? Which one of the two is the most important? Suppose you have a finite amount of funds. Which one do you give it to? And again, on this, you have the literature is very good, but not conclusive. Some people believe that the big issue is to put capital in the banks. Some people believe that instead it's helping households basically get out of the hole and not deleverage too much. And I think these are issues that are not completely settled, but are clearly on the agenda. Let me move to the second theme, which is the nature of fluctuations. And here, let me first start with a caricature, maybe, but not much of a caricature of the way macro was taught and thought about before the crisis. We had converged to a view that had fluctuations as a result of shocks, many shocks all the time, and then propagation mechanisms. So consumers would become a bit more pessimistic. This would have an effect through multipliers, and eventually they would go away. We realized there might be non-linearities, but we thought that to a first approximation, the economy was largely linear, and therefore we could treat it as a linear system. We thought of movements, fluctuations as movements of actual output around an exogenous potential output trend, in which you just went up and down, and the idea was just to reduce the gaps on both sides. And in that environment, And probably interacting with it, the tools that we had took this into account. And these were the DSGs, which were largely linear, and the VARs, the vector autoregressions, which are linear representations of reality. And if you believe that reality is linear, are basically a reduced form of what you see. And these tools proved to be tremendously useful, but probably so useful that we were very reluctant to question the underlying view of the world that they represented. And this is the interaction between tools and thoughts, and it's always a danger. These are very powerful tools, but also very dangerous ones. And the point is that I think financial crises just do not fit that vision of fluctuations in various ways. The first one is the notion of shocks. I mean, financial crises are big shocks when they happen, but they started long before. It's not as if there's a large shock. It's basically that there's a build-up and a build-up and a build-up, and then suddenly it crashes. So the shock is really not there. It's just the succession of accumulation before the shock happens, which is more a notion of, I mean, I say it here, kind of plate tectonics. Nothing happens until, which is a highly non-linear way of thinking about things. Probably is a better description. The first one is non-linear. The second one is non-linearities, right? Which is, again, go back to the liquidity issue. Bank runs are the ultimate non-linearity. They can happen or not happen. They can happen on any scale. Okay, it can be very big, can be very small. And clearly, this is, again, not very consistent with the previous view. Expectations. I mean, most of macro was assuming rational expectations, not because people believed rational expectations, but because it looked like a reasonable assumption, and cycles were not due to that. Were not due to irrational expectations. I think what we're learning, or relearning, is that there is a very important aspect of irrational expectation or extrapolative expectations, which is really what the build-up is about. And if you take this away, you probably take away much of the dynamic. So we really have to go away from it. And then the last thing is what we call long tails, which is the effects last a very long time. And this is 10 years after, and Europe is not back anywhere close to potential. And potential itself may well have been affected, at least it seems to have been hysteresis, namely the notion that a long recession or a deep recession has effects in the long run, fits the facts quite well. Again, not consistent with the previous view. So these are implications of financial crises themselves, but I think what we've learned is that this is more general. Some of these issues go beyond financial issues. They are basically true of much of macro. Non-linearities, and if there's one that we have learned about, is the zero lower bound. That's really a nasty one, and it could happen clearly outside of financial crisis, and it may well happen again. So again, the general notion that the economy is self-stabilizing, I think, comes out of the last 10 years as having much less probability than we thought earlier. So that much for what could be a much longer discussion, but I think I've made the points very clear. Let me move to the third one, which is the low interest rates. And so again, this is not a crisis issue in the sense that the interest rate, the safe real interest rates, have decreased for a long time. They have basically decreased since the mid-'80s, and they have continued to do so. And we now, because of a constraint, we don't exactly know what they would be, but they would be very low. The crisis has added to a downward trend. And importantly, they are now expected to be lower than the growth rate for some time to come. So these are forecasts based on CBO assumptions. And you can see that the blue line is growth as expected, and then the red line is the real interest rate, short real interest rate, and as expected. And as you can see, up to the 2025, the inequality holds. Now, these are expectations, there are distributions around it, but it is quite a striking fact. And we think that this has extremely important implications for macro, quite apart from what I talked about before. Okay. So a big question here, both for macroeconomists and for policymakers, is actually where do these low rates come from? Why is it that they have decreased so much? And there are conceptually two sets of explanation. The first one is, well, the marginal product of capital has decreased around the world, and therefore all the rates are lower. There's another one which says, no, for a given marginal product, people want more safety. Basically, the demand for safe assets or the demand for riskless assets has increased, and therefore we're seeing a larger safety premium or a larger equity premium, depending on the semantics you want to use. And that's really, there's just that. What needs to be done depends very much on which one it is. Fortunately or unfortunately, we have a long list of potential culprits for each, you know, from the global savings glut that Ben discussed earlier coming from China, to explanations about regulation forcing financial intermediaries to hold more liquid assets. The problem with this is that we are really not sure what the relative weight of all these things is, and therefore it's very difficult to know what's going to happen in the future. Some of these factors will turn around. There is no longer a large current account surplus in China, for example. It could be that the risk premium, which is in the stock market, may be due to remembrances of 2008, 2009, may go away. So there are all kinds of factors, but I think we have to assume that the forecast you saw on the previous slide are probably the good, right expected value. Now, what are the implications of this for macro? Well, this interacts very strongly with what I said earlier, which is the fact that the real rates are low and the fact that inflation is low implies that the probability of reaching the zero lower bound is positive, higher than it was in the past, and we have seen the effects of it. So in effect, it puts constraints on monetary policy that are probably first order. The second is, but instead it is good news for fiscal policy, because fiscal policy depends very much, you know, what kind of fiscal policy you can run depends very much on the interest rate relative to the growth rate. And if you're in a situation in which the interest rate is less than the growth rate, you have much more space to use fiscal policy for stabilization purposes or other purposes, and therefore it's important. So it clearly affects the relative mix between the two. And then the last one is in terms of financial policies. I think there is not overwhelming evidence, and maybe this will be discussed, but there is fairly strong evidence that low rates, low safe rates lead to risk-taking because of human nature, because of agency issues, and therefore lead to a higher risk of a financial crisis. So I think this third factor interacts with the previous two in fairly strong ways. So let me turn to the second part of the paper, realizing that, and we were aware that there are going to be sessions on these things, and therefore we didn't want to overlap too much. So we're trying to be not at 30,000 feet, but maybe at 15, to let the additional sessions add value, which obviously they will. Let me take monetary policy, which has been the main focus, I think, of the last 10 years. And here we've identified three challenges. I think one main one, and then two others which we want to discuss, but briefly only. So the main one is the ZLB, which is that if you look at the last 6 recessions, the average decrease in the policy rate was 5%. Now, it's very clear that there is not that kind of margin at this point, and it gives you the range from 2 to 10%. So it's clear that there is not that margin of maneuver. The current short rate is 1.25, as we know. The expected rate is a bit higher, but still much less than 5. And so the question is, what will we do if there is a shock, which is of the average magnitude of what we saw in the past, leaving aside financial crisis? Clearly, QE will be used again. We've learned a lot about QE. It will be used. It will give us maybe a few, maybe 100 basis points on the long rates, but the spreads are already extremely compressed. Therefore, it's not clear that we could do much more at that margin. So it's not clear that if a recession came next year, you would actually have the tools. But there's a question of, okay, hope that next year nothing bad happens, and we don't expect in expected value, it's likely. But what about the recessions 3 years down the line? What can we do between now and then to basically put in place a system in which we have more margin, which I think is the way we should think about this. So here there's a number of solutions. I'll just discuss them very quickly. The first one is the one that I, but others have argued, is the simplest way of doing it, is just to have higher inflation. And if you have inflation at 4%, you probably have rates at 6%, and then you should be okay most of the time. But the pros and cons are well understood. There are some costs, although I don't think they are very large. There are some benefits. The discussion has gone on. I think the only way in which the discussion is different from what it was pre-crisis is that the pre-crisis discussion concluded that the probability of a ZLB was 0. And we've learned that's not the case. So at least that computation should be done again. But there are, in principle, smarter ways of doing it, which is, well, you want inflation sometimes, not always. You basically want it when you're at 0 with a nominal rate, and then you want people to expect inflation, and therefore the real rate can come down even more at the 0 nominal rate. And there's a number of schemes which go in that direction. So nominal income targeting goes somewhere in that direction. Price level targeting goes somewhere in that direction, but they're not perfect. And price level targeting has the issue. It's very good in that case, but very bad when you're back at full employment and you have to explain that you need a recession in order to go back to path. So not ideal. So the question is, can better be done? Can you have something which basically changes expectations when you get to the 0 lower bound, and then you explain to people that inflation is going to be harder, is going to be higher. And you can think of forward guidance as trying to do that. You can think of other schemes. My reading, and Ben will come back to a particular scheme that he has in mind, which might work, but my sense is it's very hard to change expectations at the time you need to change them. I read Japan as basically telling us it doesn't work. Now, maybe we can do better, but I think there's a trade-off. I agree it's much better to inflation only when you need it, but can you do that? I'm very skeptical. I'll mention, but I will go fast on these two slides because I don't want to take too much space from the following sessions. So the second challenge is the relation of central banks to financial stability. Should it be part of a mandate? Should they be active? Should they use monetary policy as opposed to macro-prudential policies to deal with what looks like asset bubbles or credit booms? And here, this is a discussion which has been very productive, which is referred to as leaning, which is trying to stop it before it's too late, versus cleaning, which is accepting the fact that you can't do much, but trying to clean when it has happened. And our sense is that monetary policy was really not designed for that, and it's going to work very badly. I mean, increasing the interest rate when there are what you think might be credit booms or things like this may actually be counterproductive. At the margin, you may slow down the credit boom, you may decrease risk-taking at the margin, but by increasing the interest rate, you increase basically the weight of debt on everybody else, all the inframarginal, all the people who basically have debt already. And so it's not clear that it actually works well. The second is the timing, which is, we've learned, it's incredibly difficult in real time to know what a healthy or unhealthy credit boom is. Given the lags involved in using the interest rate, it may well be that you have the interest rate increasing just after the crash, and then you're in trouble. If you do it right and you stop it, you'll be accused of having stopped something which was useful. The political economy, again, is quite deadly here. So our conclusion is no. The monetary policy should be involved in financial stability, but it should not use the usual tools of monetary policy. It should basically do macro-pro with other players who clearly have to be involved. And again, this raises the issue of central bank independence that Ben will talk about. Then the third one, and again, I'll go briefly, is the size of a balance sheet. I mean, if there's something strikingly different about monetary policy today and monetary policy 10 years ago, is the size of the balance sheets, which are now in many trillions of dollars or euros. And the question here is, what should central banks go back to? And here, I think we make two basic points. The first one is that that's not a well-defined question. That basically we should be thinking about the consolidated debt of the central bank and the government. And the result is, what is the debt which is in the hands of the public? And basically both of them have an effect on it, and that needs to be coordinated at the minimum. Once you've decided what kind of debt structure you want for the consolidated government, the central bank and the treasury, then there is the issue of the division of labor. Who does what? Should the treasury do it, or should the central bank do it? And what we do in the paper is go through various arguments which have been given for wanting to affect basically the yield curve. For example, wanting to make the yield curve a bit less steep at the beginning, which is work that Jeremy has been working on. Or if you want to decrease the term premium on medium and long-term bonds, there are arguments for doing that, and there are good ones, but we conclude that in general this can be done by the Treasury for the most part, with a few exceptions. There's a footnote here, which I don't know if it is on that or not. So the conclusion is the Treasury and the central bank should work together. That raises one issue, which is for the ECB, which is, having debt management coordinated among 19 members is not exactly easy, and then having them coordinate their debt management with a balance sheet of a central bank is probably beyond what we can hope. So clearly this is a special case, an important special case. But okay, that's monetary policy. Let me move to fiscal policy. Okay, so I think here there has to be major rethinking for two reasons. The first one is because of the constraints on monetary policy, you better have something else. If a recession comes, you probably want to be able to use fiscal policy. The other is that you clearly have much more room to use it without getting into trouble because the interest rate is so low relative to the growth rate. So here we take up two issues in the paper. The first one is automatic stabilizers. And here it's absolutely striking how governments have accepted using the existing automatic stabilizers, which were never designed to automatically stabilize, but were there for other reasons, progressive income tax, various reasons like this. But there has been no work, there's been a bit of academic work, no policy work that I know on trying to improve them. And that seems irresponsible, if one can use that word. So that's the first issue. The second one is what debt policy should be. When the interest rate is less than the growth rate. Now, I think here the first reaction I get when I discuss this is, well, it's like this now, but no, maybe it's not going to be like this forever, so let's be careful. And maybe R will be greater than G. That's probably, that's surely true that there's some probability that the inequality will reverse. It will almost surely in some time. But what is true also is that governments can actually at this stage lock in the low rates, right? And I think I give the rates here. Basically, you can lock in the real rate in the US at less than 1% for 30 years. So even if the rate actually moves, that's what you're paying. The probability that growth over the next 30 years is less than 1% seems extremely small to us. So I think there is a sense in which there is really a situation in which governments can assume that they'll be operating with R less than G for some time. Okay. Now, when you tell macro theories that R is less than G, that opens a very exciting and confusing possibility, which is known as dynamic inefficiency, which is actually debt is good. This means that there is too much capital, And so by issuing debt, you reduce basically how much of saving goes into capital. And that's good because there was too much capital. I think the evidence, it's not the case. The marginal product of capital is fairly high. The safe rate is low. It's probably more safety premium than the low marginal product. So I don't think we can assume that let's just issue debt because it's good, even if we don't use it for anything useful. But then there's still the issue of, okay, you can still issue debt and in effect not repay it. And then should you do it or not? So here is the second slide. So suppose we're in a world in which the marginal product is above the growth rate, but the safe rate is below the growth rate, right? Then what you can do as a matter of arithmetic is basically you can issue debt, use the proceeds for whatever it is that you feel like, and never repay it. And if you never repay it, the debt to GDP ratio will still eventually converge. It will never explode, right? So basically you can issue debt, never raise taxes. Sounds great. You can do it. Now, should you do it is the issue. That's a welfare issue. And I think that it's fairly clear that it can be done. Even if you think that 30 years from now the inequality will reverse, it's still very much worth doing because the amount of taxes you'll have to pay will be very small relative to the initial debt. So it doesn't depend entirely on this being forever. It has to be for a long time. So here, I think there is more work to be done. And what I'm going to say here is more tentative. But at least you should be more relaxed about debt consolidation. If it's going to have an effect on output because you can't use monetary policy, you can probably wait and it's not the end of the world. So there's a fairly strong implication. If there's an output gap, as there is in Europe, at least at this stage, then please be relaxed and maybe you can wait a few years to do consolidation. I think these are implications of that inequality which are hard to escape. Politically, I realize how much of a bomb this is, but this is what comes out. And then I will end this slide with the last point, which is the case for public investment. And I think the case for public investment goes beyond this RG argument, and that's a point that Larry has made. The first is that a lot of fiscal consolidation has taken place, has taken the form of low public investment, because this is what you cut when you need to cut. So public investment has been too low, I think, in most advanced economies for a long time. So there's just an argument there which would be true in any environment. You should do more of it. The second is the R less than G argument, which is you can do it and you don't need to raise taxes later, which is useful. And then the third one is hysteresis. That goes back to one of the points that I discussed earlier, which is that it may well be that it pays for itself. By increasing demand, maybe it increases potential output, not only directly, but indirectly, in such a way that it pays for itself. It's worth doing. So I think on fiscal policy, there are fairly major implications. We've been focusing very much on the ZLB and monetary policy, but fiscal clearly is something we have to think more about. Let me end the discussion of policies with financial policies. Here it's clear that practice had to run and ran ahead of theory. Things had to be done, and they were done. This Dodd-Frank was done before all the papers were published in the EAR. The FSB has been working very hard. The Basel agreements have been modified and so on. So what are the challenges here? And here again, I'm going to go much too fast because we'll discuss it at much more length when Andy Haldane presents his paper, and there's a discussion after this. But I'll take two issues, and this is really two out of a bag. I'm not sure these are the two main ones, but these are two important ones. The first one is this old issue of, do you need just a belt, or do you need belt and suspenders? Do you basically need, are some simple measures going to be enough, or do you need to have really complicated regulation in order to achieve what you want, because the simple measures will not work? So there is a view that relatively high capital ratios and stress tests might be enough, and that kind of simple relative to some of the other stuff. And if you do this, we'll be safe. And at least on stress tests, and here I will defer to Larry, who has looked at these things more closely than I, the fact that the last set of stress tests in the US had all the banks pass it with flying colors, I think tells us more about the stress tests than about the banks. And we see this as a fairly serious issue. We could go into why stress tests don't quite do the job, but I will not do it here. And then the other issue is this tension between what I would call financial regulation, which is kind of static rules, and macroprudential, which I think is rules in which you move you move the rule as a function of, or you move a measure, the size of the measures as a function of the economic and financial environment. So the example here is, if you think about capital ratios, do you want to have high constant capital ratios, or do you want to have lower ones, but increase them when you need to? And same thing on down payments on mortgages. Do you want to have fairly high down payments, or do you want to have them relatively low and increase them when things start smelling? And I think the answer here is a bit the same as for monetary policy, which is it's going to be very hard to do it right, to basically, for both practical reasons and political economy reasons, increasing the size of a down payment when there's a housing boom basically tells young couples that not only is the price high, but you can't afford to buy it because you don't have the money. Politically, it's fairly tough. Stan Fisher knows something about this in Israel, but I think it's much more general than that. So I think that debate, the relative weights of the two, is very much still to be settled. Let me end with two conclusion slides. And that's really just repeating for emphasis what I've said. So if you think about the events of the last 10 years, and they are quite incredible in retrospect. There was runs on the largest financial institutions. Interest rates have been in a liquidity trap for 10 years in some countries, nearly 10 years in others. There are still very large unemployment gaps in Europe, which I think are partly due to cyclical factors, not entirely structural. Output is still far below the pre-crisis trends. So, things have happened. And I think in the light of this, returning to something like business as usual would be just wrong. I think what we have learned is economies do not self-stabilize by themselves. You actually have to do something. They may implode, and they would probably have imploded had the reaction been different in 2008, 2009. There may be hysteresis. There might be long-run effects of recessions. And so what is needed, I think that's a main message, you need very aggressive, proactive and reactive demand policies. Not only demand, but surely demand is important. And that's why we've called the paper Back to the Future, which is we basically, I think, have a message which is not very different from the one which came after the Great Depression and kind of went away after the stagflation. We seem to be much more in sync with the conclusions of the first round rather than the second round. So I could have stopped here, but there's one more, which is that writing a paper with Larry is a great deal of fun. And if any of you can do it, I highly recommend it. But converging with Larry is not always easy. So I have given you, I think, what is in our core. But we're not exactly in the same place. And I think that raises, and I thought it would be fun to actually raise the issue and be honest about it, which is I'm more in the evolution mode, and he's more in the revolution mode, more like Adam was in his introductory remarks. So I think the case for revolution is here, and I'll let Larry add whatever he wants. I think financial crises are very likely again. The financial system is becoming more and more complex. We don't have the right tools. The paper by Larry shows that maybe the risk is as high as it was earlier in time, and it's poorly understood. And the second is economies are fundamentally unstable. Non-linearities of various sorts are essential. Secular stagnation, low rates are there to stay. That complicates life a lot. So the kind of VAR, DSG approach, which is fundamentally linear, not entirely, again, you can modify the DSGs, but just has to be rethought. And then again, it's kind of a type of remarks that Adam will make. So having put words in my co-author's mouth, my own position is, and maybe because of sunk cost, because I have much more to lose from a revolution, is a case for evolution, which from a technical point of view, there is nothing which forces DSGs to be linear. They can be nonlinear. They now can handle nonlinearities such as a zero lower bound. They might be able to handle liquidity runs and things like this. So I think the technology is much more flexible than some people believe. The nonlinearities, I have kind of a schizophrenic view of it, or at least a conflicted view of it, which is I think they only exist in some part of the space. I think most of the time, the Great Moderation was a time when nonlinearities were not important. So as long as we played in that playground, it was okay. At the margins, on the side, when you get to the dark corners, as I've called them, but I think there's an issue. So the notion that you have to give up everything, which is whatever 90% of the time for the 10%, is probably wrong. You have to integrate the two. How you do it is not at all obvious. I'm not sure that financial crisis will happen very soon again. I think they remain rare events. And maybe I'm too confident, but I have a sense that if three policies which I've described, three sets of policies I've described, are actually implemented, we're in fairly good shape when the next shock happens, which will be a financial crisis or something else. So here there's a difference between us, and maybe that's a good way of ending and opening the floor. Thank you.
Let me turn to Larry, not so much for a rebuttal, but a re-emphasis of the core and perhaps a nuancing of what there was.
Very brief. Working with Olivier is a pleasure, but this collaboration does have slightly the character of trying to produce a duet between a tuba and a flute. And so it is a little complicated. And if you're kind of on my side of it, you have a bit of a disadvantage because the rules of collaboration are that you don't write anything that both people don't agree with. So all the drama bold statements go out. It's that you don't get to veto not saying something. You only get to veto saying something, and that's why I'm going to take 3 minutes. First, a qualification, which I think we probably should have made more clear at the outset. Olivier and I, and this I think we're in complete agreement on, though I haven't checked this morning. Olivier and I are in complete agreement on the very substantial importance of structural policies for improving the growth and employment performance of industrial economies, and believe that proper structural policies play a large role in making the world better, and that structural inadequacies are significant contributors to the various problems that we have observed, and think it is urgent to work on those questions. We just have not defined those questions as being macroeconomic policies for the purposes of this paper. And so we have addressed the set of issues relating to more traditional macro of monetary, fiscal, and financial policies that affect demand, because we think they're very important, and there need to be important changes in thinking with respect to them. It is an exaggeration, but I think not a wild exaggeration, to say that the textbook orthodoxy with respect to demand policy for the last 25 years has consisted of 3 propositions. 1, do not screw up the long run by yielding to the temptation to do things that are attractive in the short run that will end up only creating inflation in the long run. 2, do not become a source of instability by moving erratically and unpredictably. 3, as long as you're not doing one of those 2 things, lean into the wind and make fluctuations less volatile, but don't suppose that by doing your policy better, you're going to reduce the average level of unemployment or raise the average level of output through time, though you can hope to reduce volatility. And that has been the orthodoxy, and it's my view that that orthodoxy is likely highly inappropriate for the next 2 decades, and I think Olivier's view that it is flawed and not entirely adequate to the next 2 decades. I believe that there is substantial reason to believe that rather than excessive demand, the produced by temptation, yielding to temptation, the larger problem for the industrial world over the next 2 decades will be insufficient demand produced endogenously by the economy by a variety of forces that lead to a chronic excess of saving over investment. And that's what the secular stagnation idea refers to. And I would cite as evidence for that concern 3 kinds of observations. First, the observation that we have been below target inflation for most of a decade, and it is market's judgment throughout the industrial world that we will be below target inflation for the next decade. Second, that the behavior of real interest rates, where the real interest rate is measured by the indexed bond in the industrial world, averages close to 0 over the next 10 years, is substantially suggestive of an excess of saving over investment and difficulty, as Keynes noted, in interest rates enabling the market to clear. And third, the difficulty, I would argue now over a long period of time, in seeing strong and adequate growth coincident with sustainable financial conditions. We don't know what the future holds. We know what happened in 2008. We know that we now believe that the period from 2003 to 2007 involved unsustainable buildups of asset prices. We know that before that, there was a recession that began in 2000 and 2001. We know that before that, strong growth was propelled by a very strong stock market that we now judge to have been an unsustainable bubble. So if you ask, in what period has the economy grown in a healthy, sustainable way with sustainable financial conditions, it has been a long time. And that suggests that the framing challenge should be assuring adequate demand on a sustainable financial foundation, and that perspective needs to inform thought about monetary policy, thought about fiscal policy, thought about the financial policy. And I think that as Ben has been right, and the precise extent to which he's right, one could debate, but the broad idea has to be right, that high savings in surplus countries is one of the significant contributing factors to this excessive saving. There are also implications for the international adjustment mechanism. So it's this idea that instead of thinking about containing temptation to produce, containing temptation that leads to inflation without benefit, which has been the dominant paradigm, that instead the dominant problem is the shortage of demand caused by an excess of saving over investment, the Keynesian issue. That is why I think I tend towards the revolution rather than the evolution end of the spectrum, while we're in agreement on the various details that we discussed.
Thank you both for a magisterial overview. And as I said, as grateful as we are to bring everyone together for the many other good papers in this conference, it is your paper setting out the agenda that I think will be one of the key contributions. We're going to open it up for discussion with everybody in this audience is pretty distinguished, so we'll start there. But let me, if I could, Larry, just ask you one quick follow-up question. Part of the consensus and what you referred to that previously existed was a belief that in the post-stagflation world that all the political economy biases were in the soft direction, that central banks had to be prevented from going soft, that fiscal authorities had to be prevented from spending too much and overweighting the short term, that exchange rates had to be bound. And what we found over the last 10 plus years is something of the opposite, that even when there's an obvious case, as you and Olivier have made, for investment, we have not seen large-scale investment from the public sector. Even when countries have good reason, perhaps, to get off an exchange rate peg, they've been reluctant to do it. Central banks have been, to varying degrees, reluctant to push up inflation. How much do we need to rethink our political economy as well as the specific policies, or can we just do a technocratic fix to this?
This was an area where Olivier and I were not going to get near agreement.
I had a feeling.
So
that's why I'm asking.
Not an area that appears in the paper. I have written elsewhere that I thought a large part of the case for central bank independence rested on the idea that the political system was tempted to excessive inflation for short-run reasons, that the political system had that temptation, and that by insulating central banks from that temptation and by establishing credibility, by appointing as governors of central banks people who were different from the kinds of people who tended to win elective office, that you could contain that temptation. And it did seem to me that when most of the political pressure on central banks was from the hawk side rather than the dove side, that argument was importantly attenuated. And that if the argument is simply, well, you know, politicians screw everything up, and so it's really better to let smart people run it, and that's what we get with independent central banks, that's not so compelling an argument, because that's an argument that you could make in a vast number of spheres of policy. And so I think it is very important for institutional design. I think it is a mistake to make institutional design judgments in response to events that might be quite transient. And there's a very deep and hundreds of years tradition of unrestrained political temptation leading to excess inflation. So I wouldn't want to overreact to the anomaly of the last 10 years. But I do think it is conspicuous that the political pressures are really quite strong and in quite a number of places to the opposite of the side that framed a great deal of the orthodoxy.
Thank you very much. Olivier, please.
Trying to guess what monetary policy would have been in the last 10 years if there had been less central bank. Not very good. The question is, what would have happened in the last 10 years if the central banks had been less independent? Would they have done more? Would they have done less? My sense is that they would have done less. Because if I look at what has happened outside of monetary policy, namely fiscal, they basically have held to very old-fashioned notions, just in most countries, about that is bad and we shouldn't do too much. So I think that that's a case in which the central banks actually have done an enormous amount, which would have been very, very difficult without central bank independence. So it goes the other way.
No, but that's a restatement of what I think Adam and I are agreeing, which is that the political pressure on central banks, that the political world has been to the hawkish side of central banks. The question is, when the political world is to the dovish side of central banks, it's easy to explain why you should have the central bank be independent because of the insulation from temptation, dynamic consistency argument. When the political world is to the hawkish side, you can say it's better to have an independent central bank because they're smart and the political world is dumb, but that's a kind of problematic argument because that's a kind of problematic argument in the context of a democracy. So you need some structural theory in that context, and that at least is a theory that needs to be provided. I think you can provide it if you take some part of what the central banks did, which is the strong response to the proximate parts of the financial crisis. I think it's easy to say that sometimes banks need to be helped, and that's really politically unpopular, and so you want to insulate helping banks from the political process. But when it's generally sort of easier policy versus tougher policy, you at least need the logic of your standard essay, and Alberto and Alessina and I wrote one of the better known ones 25 years ago about the case for central banks. When they're on the hawkish side, the arguments that we have usually made don't work so well. There may be other good arguments. That's why I'm not calling for a change.
There's an argument which is leave it to the experts, which is symmetrical.
That's right.
The central banks know what they are doing.
Right.
That's right. And the others don't.
But leave it to the that's exactly right. But if the argument is leave it to the experts, then you have to sort of say, is central banking so different from environmental regulation or criminal prosecution or protecting nuclear power plants, or a general decision that where there are experts and the experts seem smarter than what the political process usually does, we should turn it over to the experts, will be a fairly fundamental revision of democracy. So the appeal might be a good one, but it will be a fairly fundamental.
Larry, I'm so glad that this worked in getting both of you talking. On the substantive point, though, I just want to push back slightly. We had a marvelous conference at the Bank of England, thanks to Andy Haldane, on independence 20 years, 2 weeks ago, which many of us were at. And in my presentation there, I came out with a more optimistic version of what you and Olivier just said, which is, to be symmetric, it has to be a claim for independence that it's about expertise and not being politicized in the small piece sense, not that there's this constant short-run temptation, but that it's about that, and that one can make common cause with the judiciary, with the military, with the intelligence community. There are things in society where we have experts and you delegate. And to preview Ben Bernanke's paper later today, and as you know, Ed Balls and co-authors have a recent paper on this as well, you can draw the lines on the accountability. But anyway, just to say that one doesn't have to say it's the end of democracy if we let you run everything.
I'll just say, as a person who comes out of a technocratic tradition, I resonate to that type of argument, and I think it's a good question whether if you do away with all the temptation arguments and you just say complicated, intricate stuff should be left to experts who shouldn't be really responsive to the president, whether you can sort of preserve central bank independence and preserve most of the structure of existing governments, or whether we are all economists, so we think the central bank's the most important thing, but whether experts in a large number of spheres could call for one of them to be in charge and not have to take instruction from the president in ways that would be quite, I think that'd be a valuable subject for research and for making a judgment. I'm not confident about the right answer, but I'm a little less serene that the changes would be small if that principle was consistently applied than you are.
We are committed to starting promptly at 10:30 our session on monetary policy, in part because, of course, we have President Draghi and Governor Brainerd to speak, and they have timed speeches. So I could try to provoke these two into debating once again. But with the remaining 5 minutes, I will turn to a brave soul in the audience or two to ask a question. Please, brave soul, come to the mic. And it is someone who looks like a brave soul. This is Robert, which is the definition of a brave soul.
I have a very brief, I get the chance to speak this afternoon, so you'll hear my views. But my question would be this, mostly, I guess, to Larry, but a little bit to Olivier. Larry believes in letting the good times roll and not worrying about the icebergs. My question would be, that's from the Titanic analogy. My question would be, how do you take into account the fact that we now have 78% debt GDP ratio in this country? We're, roughly speaking, full employment. We're going to 91% according to the IMF, then 150%. Are all of these fiscal facts relevant, or do you just sort of tend to disregard them? And I got your R minus G thing, but where there's a lot of unemployment, but of course now we have relatively full employment. And then you can look back at the Eurozone, the southern countries in the Eurozone who didn't worry about fiscal conditions until all of a sudden a nonlinearity occurred and the thing exploded. So the question, I guess, is how much should we care about relatively unsound fiscal trajectories across the developed world, particularly in the time of full employment?
I guess
Before you reply, for those online who didn't catch the obvious joke, that's Robert Rubin.
Why am I a joke?
No.
I wouldn't have stood up here if you were going to say that, Adam.
Robert Rubin, who regularly gives me lessons in how not to put my foot in my mouth. Please.
I mean, you're not going to learn that from Larry. Mario will agree with that.
I guess, Bob, I would say that it's usually better to compare a flow with a flow or to compare a stock with a stock. And the ratios you cite are ratios of a debt stock to an income flow. And an alternatives would be to compare a debt service ratio to income, or to compare a stock of debt to a cumulant of wealth. And if you looked at either of those kinds of ratios, you would find the trends much less alarming than the ones that you suggest. If you looked, for example, at debt service relative to GDP for the United States, you'd find that it was really quite extraordinarily low by historical standards. If you looked at the ratio of federal debt to national wealth, you would find that it was much less alarming. And so I agree with you that one needs to pay appropriate attention to fiscal sustainability, but I think it's appropriate in the same way that any regular household's view about how big a house they could buy is sensitive to the mortgage rate. And they're prepared to spend more on a house when the mortgage rate is low than when the mortgage rate is high, that some consideration of that kind is operative in thinking about debt sustainability. Whether at this moment, when it certainly seems that if there's a tendency towards mean reversion, it's probably not to propel the U.S. economy upwards more rapidly, and when the fiscal conditions, fiscal projections are hardly favorable, this would not be the moment for fiscal expansion, particularly fiscal expansion that was unproductive with respect to GDP growth. I would agree with you. Whether the arguments that you made very powerfully and that I thought were right at the time when you made them in 1993, about in an environment where there was plenty of room for monetary policy to loosen, where real interest rates were quite high, and the cost of capital was plausibly a major inhibitor to investment. You argued quite rightly in that context that I thought, that fiscal consolidation, and in particular prospective fiscal consolidation, would be an important spur to growth, and I think history bore your argument out. In the world of today, where there's very little room for interest rates, for further interest rate reduction, costs of capital are epically low, and there's little reason to judge that investment is constrained by cost of capital. All of those mechanisms seem to me to be much less operative in thinking about fiscal policy, and so the right way to think about fiscal policy is importantly different than it was in 1993, and that's the kind of point we're seeking to make.
Yeah, but are you saying that in a full employment economy, Larry, or one in which there's labor slack? And secondly, I have the opportunity to comment this afternoon, and I'm going to introduce some other factors that one might consider, which are outside of the framework that you and Olivier have.
I think there are both issues, without complexifying it, there's full employment versus slack considerations, and there are liquidity trap versus non-liquidity trap, normal level of interest rate versus growth rate considerations. I would not want to argue that we were a long way from full employment in the United States today.
I'm afraid I'm going to cut it there. As Bob bravely and rightly said, we will get to hear a discussion of fiscal policy this afternoon with the lead-off paper by Alan Auerbach. Larry will chair. Bob is one of the many distinguished discussants. But now I'd like to ask Olivier to take over the chair, but without further ado, ask Ben Bernanke to present this morning's paper on monetary policy.